All right, everybody, welcome. Thanks for taking time out of your Saturday. I know, especially during college football season, to come in for a webinar. I got to give you a lot of credit for doing it. I know that I've had one eye on the screen kind of as I've been listening to these great presentations today as well. Today we're going to talk about identifying trends with divergence. Once again, my name is Anthony Crudele, and my trading company is Beacon Trader. And before we get started, we have to do the warning, as we do with all of these presentations, basically saying that, past performance is not indicative of future results. We know that trading can be risky, and as I always say, you don't want to be risking your kids' college money on trading unless you absolutely know what you're doing, right? Be patient and make good decisions when in trading, and understand that there is risk involved. Now, I started on the floors in 1995. I was 18 years old, so I never went to college. It's the only job I've ever had. Kind of a long story how I got into the industry, but I was one of the youngest members ever of the Chicago Mercantile Exchange. I'm still a member today. I started my career in the S&P pit, and majority of what I've traded over my career has been on the E-mini S&P. I started in the pit, but I was right as I started in the pit, the E-mini had just come out. So although I've kind of come from a pit background, majority of my career has been spent on the screen. That's where I made all my money. I lost a bunch of money in the pit first. I blew through 3 accounts, and also that included my time trading on the mini. And there's a long story about that, but I was down to my last 10 grand and then finally turned around. I've had multiple 6 and 7 figure years trading on the screens, and I've traded millions of futures contracts. I've also been noted on Wall Street Journal. I've been on CNBC a bunch of times, Fox Business, talk with them a lot. CME Group and TT actually host my Futures Radio Show, which is a podcast free for everybody. I frequently talk with the New York Times, Streets, Forbes, and actually these days I talk a lot with Reuters as well. So you can pretty much follow a lot of my commentary in a bunch of different places. Today we're going to talk about divergence, MACD stochastic, and MACD and stochastic divergence. So why? First of all, let's talk about what you're going to be learning today. You're going to be learning how to build confirmation into your trade execution. See, this is one of the things that I think that a lot of people lack in the industry as traders. They come in, they just try to find like one specific thing to trade. Whether we've heard a lot about patterns today, we've heard a lot about all sorts of different things, right? Trading support and resistance levels, fibs. And the question is, how do you know when to trade those fibs? Is there ever a time where you should be trading it bigger, should you be trading it smaller, or should you stay away from it? Do you trade every fib? Do you trade every support and resistance line? Do you trade every trend line? Do you trade every head and shoulders look? And that's something that I think a lot of people don't know, and they go into this business and they just try, and then they just pick something, and then you could be the guy who picks the winner one time, and the next time it's 3 losers, and then you don't trade it, and then it's a big winner again. A lot of that is because traders don't understand confirmation. And myself included at the beginning of my career did not understand this, and it's a big part is why I blew through a lot of money. I want to talk about help identifying false breakouts. I use divergence for this a lot. Identifying when markets could reverse, which kind of falls hand in hand with false breakouts. And then you have increasing your trade probability, because this business is all about probabilities. It's all about probabilities. Now, I've traded a lot, and I go over all of my stats. And when I look at my stats, it's like the trades that I'm trading without confirmation are typically, I'm way down in my losing versus winning percentages. But when I trade with confirmation, like divergence, it increases my probability dramatically. I've learned that you want to have more than one reason to execute a trade. You don't want to have just one reason to do it, because then you're very much just like, okay, I'm just doing this every time. So then I just look at that and go, if you only have one reason to do something, just automate it and take the emotions out of it. But if you're going to be a discretionary trader, if you're going to be an actual trader, you have to identify when you should be really jumping on stuff, when you have a greater amount of probability. We're also going to talk about building confidence on knowing when to pull the trigger and when not to. I mean, a lot of people talk about when to trade. I think you also need to understand when not to trade. And for me, that's become a huge part of my life, is knowing when not to trade. I talked about it, I've traded millions of futures contracts. I know it probably sounds just totally insane to a lot of you guys. To myself, it does as well. But at the end of the day, it was really because, first of all, I was a big time scalper. And when I started, and I was, it worked well for a while. But then I was just churning a lot. And I started to learn when not to trade, when to put confirmation into play, and this is along the way I developed divergence. So let's talk a little bit more as to why I use it, then we're going to get into the nitty-gritty of it. And one of the reasons why I use divergence, and this is Thomas Edison, And he said, I have not failed. I've just found 10,000 ways that won't work. And I like this quote because for me as a trader, I found basically every way possible to lose money at the beginning of my career. And as I stated earlier, confirmation is a huge part of my game now. And the big going back to this quote, 10,000 ways that it won't work, it's just that I would basically just go in and just try and trade an uptrend, try and trade a fib, try and do this, try and do that, and I was just searching for all these different ways, and it could just be so overwhelming. And every which way I did it, I lost money. And then I started to come to the conclusion that, look, I'm never going to buy a low, I'm never going to sell a high. I mean, maybe if I do, it's by chance, but at the end of the day, I'd much rather be able to identify when a high or low is in, and then be able to trade directionally and be more directional with my thinking. So I also go back to this quote: the purest form of insanity is to leave everything the same and at the same time hope that things will change. I mean, that's basically who I was. I was someone who was trying everything and hoping that things would change. But instead, I had to change my methodology. I had to change the way I looked at things. I took some of the things that I had learned about trading, and I put it into play. And I said, you know what? Divergence really works, especially with MACD and stochastic. So we're going to jump right into it now. I'm going to teach you how I look at stochastic, how it develops. Now, I'm going to give you a brief overview of all of this. At the end, we're going to be talking about a workshop as well. So I know that other people are going to say along the way, you know, maybe this is not your actual textbook way of doing things. Number one, I have specific settings. Number two, understand that I don't go by what a textbook says and how to trade anything. I go off of what my experience was. I backtest what I look at, and then I go in and I say, okay, this is the way I want to trade this. Let's see if this makes sense. So I don't really go off of the exact methods that you probably know, or some of you may not know, about how stochastic works. And I also mess with settings a little bit. So first thing I want to talk about is something that I learned. As I said before, I feel like I'm never going to buy the high or buy the low, and I'm never going to sell the high. And like I said, never is a strong word, but I don't really look to do that. I look for the high or low to develop, and then once it does, I try to trade directionally in that next move. All right, so this is why I like this exact method with stochastic. So I look for the peak high in stochastic. When the market is moving up or down, it has to get above or below this. Let's pull out my I forget what you even call these. They're just the marker. It has to give above or below -80 or -20. Now this is just the basic settings on your stochastic, right? It has to get above it. And when it does, I go ahead and I start to circle out where the peak is. And then I finally found a peak right here where the market starts to revert back down and it gets back below that -80 or it gets back above that -20 if it were to be on the low side. Once that peak is developed, I take that and I go and I mark it to the high of the move or the low of the move. In this particular case, we're doing a high. So now that's the high bar. That's my mark. Now all of the examples today are going to be on the 60-minute. Okay. And the reason why I like this on the 60-minute the most is because it gives me that medium-term perspective. It's also great for short-term trading too, and I'm going to show you what I mean by that. So the stochastic on a 60-minute bar in this particular case had made the peak high, and then you take that to the bar. So it's very important to note two rules we learned so far. It's got to get above a -80 or below -20, and it's got to make it peak, and then it's got to start to revert back down. That's number one. So we identified that, and we take the peak of that bar. Now you're kind of in this wait-and-see game. What I do is I draw this horizontal line across, which I don't have on this chart. I don't actually draw it, but I mentally know what price it is. So let's just say, for this sake, it's 2161 in S&P, E-mini S&P. When it gets back to this price or greater than this price, okay, so if it makes a new high, or if it was a new low, it'd have to get to that price or make a new low. I then look to see where the stochastic is. Okay, so now at that bar in the E-mini S&P has crossed over that orange line, that horizontal line I drew. And then I look to see where the peak of the stochastic is. Now you can see this actually took almost a day to develop, which I like for that. The reason why I like it is because I'm saying we're making a higher high, and I'm wondering what's happening here. Are we breaking out with strength, or could we possibly revert back in? Okay, so this is good information for us. So when we go back to it, we see that it makes the high, okay, it shows that there's divergence. So on this particular day, I look at it and go, I'm identifying that this trend is probably at or near its end. Watch for possible rotations back down. And it's a potential false breakout. So we talked about that at the beginning, what we would learn. Now, I don't use this exact scenario for a trade. What I use it for is to help me with directional moves. So if you have fibs or something else, or if you had resistance at 2160 or 2165 in S&P, if something aligned with that, whether it's a fib or anything, it's a complement to what you're doing, you're saying this is a very good confirmation now that the trend may be reverting back down. So as I see that, that's very important information to me, right? I'm going to talk about how I will trade using divergence as well, but I don't do it off of a one-off, and I'll explain what I mean in a couple slides coming up. Now, when the stochastic gets into overbought or oversold territory, which that's that negative 80 or that negative 20 that we saw, watch for a retest or a higher low to indicate divergence, right? So we want to see when it gets in above or below those areas and take the peak. Now, my rule of thumb is I wait at least 2 bars after the higher low of the stochastic peak before looking at the retest of the higher low. What I mean by that is simple. When you make that higher low peak and you start to see that stochastic start to revert back down, you want to wait at least a bar or two to see that that stochastic is really reverting back down. Because otherwise it could be, what you'll see is, you'll see the stochastic peak like this, it'll come down, and then all of a sudden it goes like this again, right? That's why the rule of thumb is 2 bars. After 2 bars, typically on that down move, it'll keep going down. So then you can know that that's the peak. That's what I mean by that. Next is, I only look at stochastic when the market is making a higher low. So it's a very simple tool for you to add to your arsenal to when you should be looking at stochastic or MACD divergence. When a market's making a high or when a market's making a low. Now, basically, how you determine a high or low is just take the recent swing highs or lows, or a higher low that you could see on the chart that it's getting higher above greater than 2 bars, right? So if it's making high and then another high on a bar and then another high on a bar, you want to wait a couple of bars for it to revert back, and that's a good place. That's why I say the rule of thumb is wait just 2 bars after a higher low, and then you can start identifying this. Now, I want to go back to, I just showed you a really, a quick example on how I looked at a stochastic divergence. And decision making, I use this in pretty much every one of my presentations, no matter what I'm doing and what I'm talking about in the markets. I typically only trade off of 2 things. I use my support and resistance levels that I created through my beacon indicator, and I use divergence. That's really it. I keep it very simple. I don't look at anything else. And even with that, there's a lot of decision making to be made. A lot of decision making. Do I buy it now? Do I buy it in front of my prices? Do I buy it at the price? Do I try to buy it below the price? Where so many things going on, and as I said, or I actually had read one time, and I was in a blog, and you never know if it's true or not, a trader had said, hey, you know that a trader makes more decisions in a day than like a brain surgeon or some surgeon or something like that. And I was thinking about it, and I was like, that's interesting, because we do make so many decisions. It seems so easy when you look at it, and it's like, okay, we're either going to buy or we're going to sell. But a lot goes through our mind. So what I've learned, in order for me to be able to be really successful at what I'm doing, I need to have really clear-cut decision-making when we get to levels. So when we get there, I like to know directionally which way I want to be. So I just showed you a stochastic that showed divergence on the high. So when the market's making a high, and I see that there's a potential or there is divergence and it might revert back in, my decision-making is maybe be more aggressive with short than to be aggressive with longs. So right away, I've taken some of my decision making out of the having to make it in a microsecond when you're about to execute. I know if I have a buy signal, maybe I'm going to be less inclined to do that because I have stochastic divergence on the high. Maybe we're going to revert back down. If I have a sell signal, maybe I'm going to be more aggressive with it. That's extremely important, and it helps you because now when you're going in and you're getting ready to trade, you just go right in and you could just do it. You execute. So this is a big reason why I use divergence. It just complements everything I'm doing. Let's go over some more examples, because by one example, it's hard to see exactly how it works and it's hard to remember, right? So a couple things I want to go over. First, let's look at the 2 green circles up here. You'll see 2 green circles, and you'll see a high, which was right here, okay? And that high was determined, why I circled right there, was because this was the peak of the stochastic. So if you remember, let's go through our process, right? Peak of the stochastic. I want to see when it gets above or below the negative 80. Okay, there was one back here prior to, but I'm using this one. And I take that peak of that and I go all the way up and I circle that bar. All right, I circle that bar. Now I draw a horizontal line across. It's not the perfect horizontal line, but now I wait to see when it takes out that high after 2 bars, which in this case it did. You see 1 bar here, 2 bars. Now it goes back up and it makes a higher high, and you see right there that the stochastic is lower. So that, to me, on that high, that's a false breakout. This is a possible reversal move. We're now going opposite. You can see the stochastic is going lower, and you see we've waited 2 bars, and this is over several hours of time, and the velocity of this move, just by me looking at it, was actually stronger than the prior one. So for the stochastic to be going down, that's like a warning sign. If I'm long the market, I'm like, maybe I should be looking to cover. I'm keeping my stop tighter. Or if I'm looking to start getting short, I'm more imminent to wanting to be short. And I see a lot of questions are coming in here, and I'm going to answer them all at the end, so don't worry, I'm not ignoring you. So this is one example. Now let's go to another one. Peak low of the stochastic, right? Has to be below -20. That's the red line, right? Very simple, right? Goes up. You see the low of the market. You draw a horizontal line across. You're like, that's my low. I'm going to watch that low. If that low gets taken out, I am going to wait and see where the stochastic is. In this particular case, it goes down. It makes a lower low. As you can see right there, the stochastic was way higher. Another false breakout, and we came right back up. And basically, going back to what the S&P, when we were a range trade, and I trade a lot of S&Ps, I'm very active with it. You know, it could be, you could just get nickeled and dimed in it. And it's just like, well, I mean, how do you know that they're going to come back into the range and so on and so forth? That's why I took a snapshot of this time where we kept seeing divergences. And it's like, if you guys remember recent memory, the S&P was 44 days in a row without a 1% move. And it's so easy to get chopped up. This is when divergence helps me out greatly. And during those times, I'm waiting for it to take out a higher low. Is it near support? It gets near there. I look at it. There's divergence. Okay, we revert back in the range. We're probably back to a range-bound trade. We're just playing ping pong with the market right now as it's trying to break out. Now, also, one of my other fellow presenters actually talked about double tops, and I was once again, I don't trade patterns at all. But I do look at double tops. They're very recognizable. You know, if a market makes a high and then it goes out and retests it, and if it makes a low, then it retests it. He talked about how potentially you would maybe, you know, there's one specific time where you would trade it, and maybe the other 3 specific types of double tops you probably wouldn't. Now, what I like about what he had said is very similar to something that I would look at, and what I like about that is that when I look at double tops, I immediately look for what's happening. Is there divergence, right? Are we going up there? Is this, as we're making this double top and we're sitting near that high, is the stochastic going higher than the previous high, or is it divergence? So I keep a really close eye on it to see what shakes out. So here's a particular case where we had a peak high in the stochastic again. You go up, okay, and it actually had gone to this high right here. And then we made 2 higher highs. Both times, the market was showing stochastic divergence. So from this high right here, we went across. Every time it breached it, it was showing divergence. And if you notice, look what happened afterwards. That was the biggest break we had, I don't know, it was just a few weeks ago. And it was a double top, and just bang, they just pulled the rug out from underneath them. And a whole way down, I'm looking at it going, if I had support along the way here, I am not overly anxious to trade it. Why? We just had a double top with divergence. So once again, it's not about necessarily, see, so many people are always looking for the perfect trades, or you're looking for all these entries. How about identifying direction? How about understanding what's happening in the market? How about knowing when not to trade? How about knowing when, if I was short in this particular instance, that I'd try and hold them and press them? I mean, this is where I got really good at my craft. If I'm short this day and I see that's a double top and I see momentum's going to the downside and I see that there's divergence, I'm not covering shorts, I'm selling more. Now, because I have the confidence to lean on a certain area, I have the confidence. Obviously, you have to have your short-term risk parameters as well, but it's like I understand that this direction makes sense. So what I'm seeing is making sense. The reaction makes sense, right? It's all about the reaction to things. So this is one of the main things I use it for. So how do you become a better trader by using this? I've been talking a lot about confirmation, not always just looking for trades, but to eliminate the amount of decisions that you're going to make and what levels you're going to trade. And then when you're in levels and you get in at a level and it is going directionally, to look around and say, what's happening in the bigger picture? I just saw a double top. I'm short. What's that?
Oh, sorry, I didn't realize I had my mic on.
Okay, sorry. Um, hey, I'm short, and I get kind of confirmation that all of a sudden we're starting to rotate back down. And you look at this, and so I put this picture up of Jordan Spieth and his caddy. You don't think that, I mean, if you don't know who Jordan Spieth is, he's a great golfer. He's one of my favorite athletes. I really like the guy. Um, why do golfers have caddies? Why do golfers? Phil Mickelson always is talking to Bowen about help me read this putt because he wants confirmation, right? He knows what he's doing. Just like I know if I have a level that I want to trade, I know if I want to sell it or not. But if I look at it, it's like, do I want to have that extra reasoning behind me? Yeah, it makes me feel better. It's like a warm blanket. Remember I said you don't want to have just one reason to do things. You want to have confirmation. These divergences that I use confirm a lot of my decision making. So it doesn't matter how good you are. Like Jordan Spieth is probably one of the best putters in the world. He still has somebody say, yeah, that might be a little bit left to right instead of just straight or what have you. Instead of one, it might be inside left edge. Whatever the case may be. And this is extremely important in your trading. It's extremely important because with any professional, you're going to make decisions, and you have to be you have a lot of decisions that you have to make, and you have to be very crisp with your decision making because this is your money. So for me, it's always been about when I see something happening that's coinciding with one thing, is there something else confirming what my idea is? A lot of what I do with like even fundamentals and like technicals, how I combine those two, same thing. I mean, it just goes, everything I do has to have something follow up behind it. Now on the technical side, we're going to talk a little bit more about MACD. Now MACD I actually developed before stochastic. MACD, what we're going to learn here, it happens quicker. So stochastic, you saw, wait 2 bars, it takes a little time to develop, but ultimately you're going to get a good result. So my stochastic is like my slower moving one. Now my MACD one happens a little quicker. So let's talk about that. So very similar format at the beginning. You need to have a peak in the MACD, right? You have to have above the 0 line and a peak and a substantial peak, right? Meaning that you don't want to see it at the 0 line. Okay, I'll just draw something up here, and it peaks like this, and then it gets below it, and when it's cycling and it's just doing stuff like this, and everyone just goes, "Oh, look at all these divergences, Anthony." No, like get a peak that's above the line and then come back down. Okay, something, and look for the move to have some substance behind it, not just overnight oscillating around the 0 line on the MACD. Now, you see it here, makes a peak. You go up. You take this high from that peak of the MACD, and now that's your target. That's your starting point. So a lot of people, like I said at the beginning, this is not your typical way to look at MACD. This is the way I look at it. So what I want to talk about is that when you see the peak of the MACD and it starts to revert back down, and you see that that's the high of the peak, I go to that bar. I don't look to the high of the market of what it is at the time. I'm not looking at is the MACD going lower versus the next bar. I just want to know peak of the MACD, what's the peak of the bar? That's number one. Number two, what am I looking for? Right? I'm waiting to see the MACD. Once it makes a peak, I draw a horizontal line across again. I don't draw these all the time. I know where they are, where the price is, so I know it's making a higher, higher, or low. And when it does that, I wait to see where it is above this. In this case, we're doing a higher high, above it, but after it touches the 0 line, which it does right there. So you see that? MACD has to go back to the 0 line. Very important in the way I look at this. This to me is one MACD peak to the 0 line. All right? Once it gets to the 0 line, and it's above that horizontal line, above that price, I look to see if there is divergence. So that's how I look at it. So here we go. On this arrow, you go up, you can see, and then you go and you look and see that the peak of the MACD right there was lower than the prior peak, but the market was higher. So this is telling me that we are, what? It's a false breakout. We might be reverting back in. Majority of the time, we're going to go back and at least test that high of the MACD, where the MACD came in, and we went right back to that orange line, and we look at it and say, okay, and these red dots you see on there, that's just my MACD indicator because I created an indicator to notify me for these so I don't have to sit there and do this every time, although I did do that for a greater part of a decade. Now, that's how MACD divergence develops. Peak high, peak low, look at the peak from the MACD has to revert back to 0. If it gets above that high or below that low, there we go. You look to see for divergence. So let's do a quick recap. When the market makes a higher low, look at the MACD. Pretty simple stuff, folks. Find the peak of the MACD and match it to the higher low of the bar. Right? Don't tell me that you use a different high, use the peak high of the MACD, that's your starting point. When the MACD reverts back to 0, you can then wait for a retest of the higher low and compare where the MACD is for divergence. Very simple, right? I don't complicate this stuff. I've got too many other things going on. I mean, the market, when you look at markets, and I'm going to say this over and over again with these decision making, you've got to know directionally which way you want to be, and then you because of something, whether it's support or resistance line, and you need to have something to confirm it. So here's something that we're going to talk about identifying. We're going to show you more examples identifying it with MACD. So once again, all charts are 60 minutes. Market makes a low. Now I know you may see other ones in here. That's fine. I'm only circling so many on a chart. I drew this line across. Here we go. Market makes a low to the peak low of the MACD right there, right? Market goes down. It makes a lower low right here, right? You see it crossed it. Where's the MACD? The MACD at that point is higher than this one. That's divergence. We snap back up into range, right? Just showing you some quick examples. MACD makes a peak right here, right? That peak high is in here. We draw it across. Market, remember, not until it goes back to 0. Until it goes back to 0, right? Now it goes back to 0 right there and touches it. This next peak up right here. Okay, you go up. Lo and behold, that was that double top. Market made a higher high from that orange point. Another day, this is a time where we had what's called a twofer. I'll explain what that is in a second. But we had divergence on this high right after the MACD went back to 0, had made a double top or a higher high from this point, and bang, we came right off. Fell like a cliff, just like the stochastic one. Twofers. This is what I talk about. Twofers. So I use MACD and stochastic overlaying each other, and I'm going to show you when I get to my live charts in a little bit. And you guys obviously have said confirmation so many times today. You're going to be saying confirmation when you leave here. It'll be the drinking word tonight for sure. You hear somebody say confirmation, you take a shot. But it's one of those things where I can't say enough of it, how I have a philosophy. Like I said, I only use support and resistance levels. I use correlations as well. There's other things I use, but in terms of technical side, I pretty much use my support and resistance levels, and I use divergence. So divergence helps me identify trend, and that helps me identify which potential side of the market I want to be more aggressive on, which side I want to be less aggressive on, and which side I maybe don't want to be on at all. Okay, so twofers are times where I don't want to be on the opposite side of a twofer. What's a twofer, right? 2 for 1. So this is when both MACD and stochastic have divergence at the same time off of the same bar. I look at those scenarios and say, I don't want to fade that move. I want to be in on that move, and these are the only times that I use these indicators purely as a possible position. So let's talk about that. So stochastic, right? Let's get back to it. We made a peak low here. We made the peak low right here, right? Let's draw a line across. All right, I had the old blue circle there from the MACD one I just showed you. Here's the MACD, same exact one. Peak in the MACD. There's the blue circles circling that bar. Draw the horizontal line across. Right. Now, what got really interesting here is that the S&P took out both of these lows, and then it makes a lower low. And in both instances, the stochastic and the MACD had divergence. Right. Twofers. Bang. We ripped up. I mean, we ripped off of this level quickly, okay? Now, can't make this stuff up. Goes up, makes a high. We got the divergence. I already showed you this one. It went back to 0. Shows you MACD divergence right there on this bar with the red circle, right? Stochastic had the same thing happen. Peak of the stochastic was right here. That bar came in right there. They were different starting points on the bars, but the ultimate result came into being the same. Twofer both had divergence, bang, this thing dropped like a rock. So when I see that, these are moves I don't fade. These are moves I try to go with. Okay, so it's like if I have a long at 2160, I'm very cautious of that. Do I have divergence somewhere else? Is there something else happening? And I'll show you on my short-term charts how I utilize some of this. So I just gave you guys a really good overview of how I use divergence, right? But let's talk about when it's less effective, because I don't care what you're trading, it doesn't work all the time. That's just reality. Okay, if you think that every divergence I just showed you is going to work, it's just not. It's not reality. Not every support line is going to work that you look at. Not every trend line is going to work. Not everything you look at. So when is it going to be less effective? So you once again, trading is about probabilities. That's it. So when markets are trading overnight, low volume on short time frames, you see something happen on the cash close in the S&P and the 5-minute chart, and then you see overnight we retest that high, and you go, well, that's divergence because the stochastic and the MACD didn't work. Well, cash close on the S&P is one of the most active times of the day where the most volume is, and then you're comparing it to divergence at 6:30 at night when no one's trading. Okay, be smart about it. Okay, those types of divergences are not as effective. So if you're using shorter term charts, understand that, right? And in markets with very low volatility. I really don't use divergence on short-term charts like on the 2-year, 5-year, 10-year markets. I do trade treasuries and bonds. I mostly trade them on data, on numbers or Fed days, but those markets I typically only use a longer-term time frame for those. So on low volatile markets, maybe you're trading GE or a stock that doesn't move much, you want to go on a longer-term time frames. Short-term time frames, not going to work so well. That's something I'd stay away from. I put a fib in here. I don't trade fibs, but I put a fib in here because everybody always asks me about fibs. It's such a very common way to trade. And what I want to talk about in this is I want to give you an example of, and I have a lot of traders I've trained how to use divergence that use this on fibs. And how do they use it? What do you look for? So the key is to when we get to I don't know, whatever fib line you're trading, to me it's irrelevant. Like I said, I don't trade fibs, but I want to show you how divergence will help you. It's simple. What you want to do is when it gets to your fib line or whatever line that you're looking at, and you're interested in selling it or buying it, look to see if there is divergence. Now here's just, I put a 5-minute crude chart up for this. We make a peak high right here in crude. You go up, you see that the peak high was right here. The first time it went up to 38 back or whatever someone will be looking at, right? And then it goes and it rotates back down and it retests it. Now that it retests it, I see that the divergence is there. I look at it and go, we made a higher high. We're right at this fib level, which is 38 back. And you look at it, and the market got a nice rotation off of it. Okay? That's what I look for. Those are the times I look for it. And I have another one on this chart that I liked, and I circled. This was interesting because this is something that I like. See, as I said at the beginning, I feel like I'm never going to buy the low or sell the high. I don't try to do that. I think that so many people try to do that, and I just go, why? I've made a lot of money in this industry trying not trying to do that. I mean, of course, I try to do it, but I don't set it out to where it's like, okay, I'm going to try and pick a top here. That's just I don't trade that way because these moves always go further than you think, and once they develop and I know the direction, at least I can make money in that direction. So what I look for is scenarios like this. I really like this scenario. And like I said, I don't trade fibs, but this is something that would make a lot of sense to me. So when you have 618 up here and you have halfway back right here, they're in these fibs, crude is going lower, and you're looking at it and going, man, I want to be short this thing. And you look at it in here, it held halfway back. You might have got chopped up a couple of times, and you're kind of wondering, is this thing going to go? Like, what is going on here, right? So what I did was I looked at this particular day, and I said, look at this peak high in the MACD. Actually came in right on this bar, which was right on the halfway back. So I was like, oh, that's pretty interesting as I was looking at this. And I saw that the market had started to rotate, lower, and I saw that the MACD eventually went back to zero right there. It didn't go back right here, it went back right there. Then it goes across and it makes a higher high, and the first time I noticed divergence was on that bar. That was finally the bar that never got retested out of these prior highs. Like from there, we went straight down and made a new low. So you could see the divergence set up. So this is a time where I look at it and go, if you're looking to sell crude and you were kind of going, oh, it already went back to 38 a couple of times, you thought that you might have caught maybe your 10 or 20 cent move, when all of a sudden following that up was almost a buck move lower in crude. I mean, it ended up being further as I moved the chart over, but at least it broke another 40 cents plus from here. And that's why I don't feel like I need to be the first one in all these moves. Another reason why I like divergence so much. Now, lessons learned today. Let's recap a lot of this, and I'm going to get to some live charts. When a market's retesting a higher low, look for divergence. Simple rule. Divergence developing indicates that the trend may be at or near its end. May be at or near its end. Near a reversal as well. So when you look at it, look for it to confirm something else maybe you're looking at. Divergence has a prior probability of working when you're using divergence on the bigger picture trend. So I think with any indicators you look at, the further you go out on the time frames, the better they're going to look. So if you're looking at a 1-minute chart or versus a divergence on a 60-minute chart, the divergence on the 60-minute chart is probably going to hold more weight than a 1-minute chart. And I'm going to show you a little tool that I use for execution by using the longer terms aligned with the shorter terms. Divergence provides great confirmation at levels, fibs, support, resistance, trend lines, etc. It doesn't matter what I'd be trading, I'd be using divergence. That's just me. It's the no-brainer look I go to every time. It cuts my decision-making down in time. I see that we're at any sort of level. If a friend told me, hey, look at this fib, I have one of my good friends who's in the trading room with us who does trade fibs, and he's like, oh, look at this fib. I'll look at it. The minute I look at it, I wait to see if it tests that level with divergence, or if there's divergence on the bigger picture, and this is a shorter-term trend, a shorter-term fib, and it's confirming that same thought process. I'll show you what I mean by that in a second. Could be hard to understand. Through confirmation, you're able to know when to potentially trade bigger, smaller, or not at all. If you're someone if you're a futures trader and you're trading the same contract size on every single trade, I just don't understand that. For me, I've had a lot of success, and that has never come from trading the same position on every sign. For me, I'm very situational. What's happening? Right? Is a divergence, a double divergence on the lows, and I have a buy signal, I'm going to step in and I'm going to trade that more aggressive. There's a time, where there's divergence on the lows and I have a sell signal and maybe I want to be short, but then I tighten it up a little bit and I trade a little bit smaller and I take a little bit less risk. I go back to this. Either you're going to be a discretionary trader and you're going to be able to be really good at your craft and you're going to have a few things you look at and weed a lot of this noise out, and you're going to be able to make good decisions and you're going to be able to trade bigger or smaller or not at all. Otherwise, if you're going to trade the same contract size all the time, then basically you might as well just automate what you're doing because you're never going to be able to really take advantage of the market. You're going to be able to you're going to be hell-bent by your strategy. I mean, that's just the truth. If I traded the same contract on every position, I basically would just automate it. That's the way I look at things because now I'm just hell-bent by that strategy. But that's my 2 cents. Now, I'm offering a workshop, beacontrader.com/now. Now, there was a lot of talk today on patterns, support and resistance, great stuff by my fellow traders. This workshop will be a tremendous help with whatever it is that you're doing, whether you're working with one of the other traders that spoke about, or if you're trading support and resistance levels, patterns. I have personally used divergence for many years, and it has been essential to my trading success. And all of my training on how to use my beacon indicator, which is my #1 tool for trading, I use divergence. Period. I use it even when I'm not a stock trader, but I invest in stocks. I look at divergence, right? Doesn't matter what I'm trading, what I'm doing, I use it. This is something that you will all use in all of your trading. It's a 3-hour course, 2-part video, hour and a half each, and it's 100% satisfaction guaranteed. If you don't love it, buy it, watch it, tell me you don't like it, I give you your money back. I don't fool around this business. I've been around too long. I want to help traders. If they aren't going to be helped by what I'm giving them, then don't do it. Tell me you didn't like it. It's $97 worth of risk. You buy it, you watch it. If you believe it will help you, then I believe in karma. Then you let me keep that. Then you let us keep the $97. If you bought it and you're like, man, this is not for me. I don't like it. Doesn't fit what I'm doing. Hey, shake your hand. I wish you all the best in what you're doing. But I know for certain, if you use this, it will definitely help in your decision making. Now, also my 9 instincts you must have for day trading futures. This is my most popular video, and it's really because a lot of people go through trading stocks and then they trade options and they trade futures, and they kind of try to get into the futures game by doing those same types of it's a different monster trading futures. I mean, I'm gonna be the first to admit it. I'm not someone who goes in and I just don't go in and start trading stocks. It's not my world. It's not what I do. I trade futures. Okay, there's a different thing for this. It's faster. It's more expensive, there's more leverage, and you need to have instincts. Day trading rules for stocks, some transfer over to futures, but not all of them. You will not be go wrong by watching this 9 instincts video. I pretty much guarantee you're going to like it. So I want to talk about a couple things. We're going to get into some charts here in a second. And the question I always get, not always, but the question is, why should I take this course? And I go back to those beginning reasons. I found 10,000 ways that things wouldn't work. These things work for me. Once again, they've worked for me. and they have helped my decision making. That's what's so important to me. This is a business of probabilities. And when you go in and you're looking to execute a trade, it's really nice to have that warm blanket of confirmation around you. And that's the main reason why I say you should do this. A few things you're going to learn before we get into live charts: step-by-step instructions, specific settings. A lot of the questions I'm getting already: Anthony, what are your settings for MACD? What are your settings for stochastic? That's why you need to get the video. It goes over it. I'm not going to spend all this time here today going over all the rules and all the settings. I gave you a very good overview of what it is. How I prepare using it. Basically, we're going to get into that in a little bit here in a second. We're going to talk about how to scan markets as well. We're going to get into that in a second. I'm going to give you a little taste of it. And then how to use divergence for lower risk trade setups. We're talking about probabilities enough, right? I use support and resistance levels. All of us do in some shape or form. This is going to help you with that. When to trade bigger, smaller, or not at all. When to let winners ride and when to cover losses or gains earlier. I touched base on that a little bit as well. And don't forget that video. beacontrader.com/now. Now, I put this quote box in there before I get to live charts. It's by April Underwood. Our trading room is run by Slack. We use Slack. It's $7 for a trial for 30 days. If you're interested, you can hear me on the mic Monday through Thursday, 24 hours trading room. You can see live trading every day. So if you want to check that out as well, you can see that if you're going to buy the beacontrader.com/now, which I would recommend doing, because you're going to see how we use it every day. Now, I've learned that asking questions isn't a sign of weakness. Rather, it demonstrates curiosity, engagement, and intelligence. So while I'm starting to go over some live charts, and I know my time is limited, I will try to get to as many questions as I can. I see a bunch on there. Definitely ask those questions. So that's why I like this quote so much. I'm like, people, ask me questions. I mean, that's why you're here. That's why you're spending time on a Saturday. Fire away. So let's go over a couple of things, a couple of markets that I recently used, and I see a lot of questions, so let me get into it. Let me go over a couple of questions while you look at my charts. So let's start with Arthur. Yeah, I put the links in. Yes. So 2-minute warning. I'm sorry, I already went over, Renee. I will be done in 2 minutes. Peter Lee, short SPY, he's short SPY, confused what it'll do next, but most likely the Fed will not raise rates. That's a pretty big question for me to answer within 2 minutes, Peter Lee. What would I expect in front of the Fed meeting? Right now, I'll do a little bit of S&P commentary, but expectations going into a Fed meeting, I know I could tell you this, I will be going flat into the Fed meeting. That's the best thing I could tell you. I don't go into positions in the Fed meetings. I trade for the days or for the weeks, and this Fed meeting is too important to put any risk on there. So my opinion is I'm going into it flat. A lot of questions about settings. What is my indicator available on? They see the indicators on there. It's available in NinjaTrader and TradeStation. Do we have a trading room? Yes. There's a lot of stocks that people are asking me to analyze. As I said today, we are cut with time. Take a trial of our room. Come in there. It's $7 for 30 days. I can analyze stuff in there. $7 for 30 days. You know, take a chance for that. Glad you liked it, Ali. I see a lot of people. I'm glad you enjoyed it. I want to go over one thing here. You guys already have the link. So basically, Renee, you can come on anytime. But I just want to show them one thing that I use consistently. Which one is it? MB3. So this is something that I use a lot. Okay, and I want to show you this before I go, because this is something that is extremely important to me when this is one of the things you're going to learn. People talk about scanning, and I talk about preparation. So what I look for is I take my longer term time frame, whatever time frame you trade. Let's just say that you trade daily or weekly. 60 minutes is a good time frame to see what's happening on the charts. Market makes a low here, okay? It shows stochastic divergence. Now, first of all, the green lines and the red lines are showing stochastic divergences on lows or highs. Blue dots and red dots are showing MACD divergences because I didn't have time. I wanted to keep my indicators up here, which I said are also available as a special price today for NinjaTrader and TradeStation. That is in the beacontrader.com/now. We made a low here in S&P right around 21.25. Okay, just at the the middle of the day yesterday. And I'm just going to live right now. So right now, when I saw that, what we look for, what I tell our traders to look for, if you're someone who's going to look for divergences, look for buy divergences now versus sell. So this is what happens, right? What happens is that 60-minute indicates a buy, or not a buy, but it indicates support, divergence on support, right? And then the market, you look at it on the short-term time frame, and it confirms. So now if I see divergence on a 1 minute, it's like, okay, if I want to try and play directionally, I'm going to try and play directionally long. Here's a scenario where I had stochastic divergence on the low and MACD divergence. So we had divergence on both MACD and stochastic. Remember I said before Twofers? That coincides with the 60-minute. So along the way up, you see sell divergences, and they're powering through them in the S&P. Because we just had divergence on the 60-minute on the buy side, and divergence on the 1 minute is the one I'd be focusing on. So now my trend is, I'm looking at the market saying, from the 21, 24 to 25 level, we got it on the 1 minute and the 60-minute. That's not by coincidence. We start to run up. Be cautious of being short. If you're long, you try and hold and press. That's a very, very, very simple way to look at things. Okay, gotcha, Renee. You just chime in at any point in time. NT7, NT8 soon. Jill. You can get NT7 right now. NT8 is still in beta with a lot of what they're doing. Once we get the green light, you get the free upgrade in NT8. So definitely, there's no cost to you by going from NT7 to NT8. And even same with TradeStation, every upgrade we do it. Do I primarily cover E-mini in my S&P trading room? No, I don't. I trade S&P the most, not really this year. So here's what our trading room looks like. In the center, you will see our entry prices. That's not exactly where we enter. It's kind of a long story on that. Not really a long story, but the entry price is where the signal's generated from. So we look at that, and I'm not entering every single one of these markets on every signal we generate. I don't trade every one of them. I talk about each one, and it's very clear to our traders which ones I'm taking. And it shows what our stop losses would be, what our profit targets would be, which we also maybe don't wait for all profit targets either. And it shows what the last trade was generated in P&L. And this is all saved for you in the back end of the website for all the markets that we do, and you can go through and look at every signal that's generated. So we're very transparent that way. Markets I primarily focus on are oil, gold, S&P. I trade euro, I trade pound, I trade yen, I trade NASDAQ, I trade Dow, but the ones I trade the most are gold, S&P, and crude. This year actually happened to be a lot of currencies. I've been trading a decent amount of pound, yen, and euro lately. Not a ton, but just because of the movement of the dollar. So when the dollar is moving a lot, I'll tend to look at currencies.